This is the Daily Market Comment by Mario Sugiriakos. I'm Christina Marujos. Thanks for joining us at XM.com. The U.S. stock market rallied furiously on Monday with the tech-heavy NASDAQ 100 gaining 3.1% to come within breathing distance of its recent record highs. But in the FX arena, havens such as the Japanese yen and Swiss franc shined bright, while risk-sensitive currencies like the Australian dollar surrendered ground. Crude oil fell substantially too. Overall, it seems the currency market is not quite as sanguine as the equity market about what lies ahead. One explanation is that the enthusiasm in the stock market had unique catalysts behind it, such as the unveiling of the new iPhone, or perhaps we're witnessing another options-driven buying frenzy like the one in August. When big players bet that a stock will rise through options, the dealers that sold those call options must hedge their exposure to avoid losses, and that is done by buying the underlying asset, which creates a positive feedback loop. The situation is back to normal today, though. Futures point to a slightly lower open on Wall Street after Johnson & Johnson paused its late-stage trials for a vaccine, and the sour mood is reflected in both bonds and FX, with long-dated U.S. yields moving lower while the defensive dollar is a touch higher. Elsewhere, the euro is having a bad day. Infection numbers have gone through the roof across Europe. The recovery is already on wobbly legs according to the latest PMIs, and if stricter measures are enacted, then all bets are off for economic growth in the fourth quarter. Things are looking grim for the Eurozone, and if markets sense that the economy might even contract again in the fourth quarter, the single currency could take heavy fire. That said, Euro-Yen may be a better proxy to capture any Euro weakness, as both the dollar and pound have politics to worry about right now. As for today, the highlight of the economic calendar is the U.S. CPI data for September. The core CPI rate is expected to have ticked up, which could reinforce the Fed's reluctance to commit to any new stimulus for now. This was today's Daily Market Comment. Thanks for watching at XM.com.